Today on Retire with Purpose, how the A word may affect your finances, the biggest risk facing retirees today, and is gold really the best inflation hedge for your retirement?
Are you prepared to retire with purpose? To retire knowing your savings is invested to meet unavoidable needs and expenses.
It's not how much we make during the good times, it's how much we keep during those really bad times.
Certified financial planner Casey Weade is president of Howard Bailey, an advisory firm that believes successful retirement begins with a detailed financial plan personalized to help achieve your life's purpose.
Whatever risk you faced, we've got a plan.
The Howard Bailey team is committed to practical financial planning so you can enjoy family and the future without uncertainty or stress. Stay tuned and learn how you too can retire with purpose.
Thanks for joining us. My name is Lee Kelso. I'm here with Casey Weade, certified financial planner and the president of Howard Bailey Financial. We begin the program today with the A word, and that is something that you're going to learn about in an article in Forbes magazine called How the A Word Might Affect Your Finances. And this article is included in Casey's weekend reading for retirees and pre-retirees. You can go to retirewithpurpose.com and sign up to receive a weekly email there with several different financially related articles and then Casey's comments to go along with them. So what was there about this one that caught your attention?
Well, I think the name caught my attention. I really like the way they said the financial A word, because there are a lot of people that will come in our office or that I'll talk to on the street, for that matter, that I'll talk to on the golf course that say, I just hate annuities, or I don't want annuities. I don't want to talk about annuities. It is this thing that we just don't even want to confront. A lot of people don't even want to actually discuss it as a potential solution for the retirement. And this trickles all the way down to financial advisors. I hired a financial advisor here recently that came from one of the largest brokerage houses in the country, and he was always told how bad annuities were. In his first interview, he said, if we're going to be using annuities, then I don't want to even continue this conversation. And it got to the point where now he works on our team, and he's moved his parents' money over, and a lot of it went into annuities, because he said, now I see how great a solution these fixed indexed annuities are, and they fit the right bill for a retiree looking for consistent conservative growth without market risk. I don't have to worry about losing mom and dad's money anymore, and they don't have to worry about losing their money anymore, and they can still earn a decent rate of return. And I had a client that was in the other day. He's been working with us for over 2 years, and he was an individual that needed a flexible income strategy. He needed growth, and he wanted some growth. He was comfortable with some risk, but he also wanted a fallback plan. So out of his portfolio, we carved out about 40% of it, set that aside in fixed indexed annuities, where he had 75% growth of the market, and he also had a 1.5% annual fee. His gains locked in every 2 years. He just had his 2-year anniversary, and when he came in for that 2-year anniversary visit, we sat down. This is before the market had its major pullback, and he said, I was playing golf with a good buddy of mine the other day. He's a financial advisor. He said he would never put his clients in annuities. He said, what would you say to him? And I'd say, well, why don't you just ask him what his clients have returned over the last 2 years, and then tell him what you've returned over the last 2 years. And at that time, he had seen double-digit returns over 2 years in a fixed index annuity without any market risk, probably outperforming most people that were actually in the market over that period of time. And then subsequently, we saw this big pullback in the market. Well, that advisor's clients probably lost a lot of money. He probably had a lot of stress on his clients and on himself. This individual locked in all his gains, and he didn't experience any negative returns over that period of time. So I think what this article does is it dispels some of the common misconceptions that people might have around annuities, and it really just spells out how a fixed indexed annuity really functions in a very easy to understand manner.
Well, you said you put 40% of that particular client's portfolio into an annuity. How do you come to that percentage? How does somebody decide?
Well, in this article, they had said to use the rule of 100. So Forbes article saying, use the rule of 100. So, and this has always traditionally been looked at as bonds and stocks, right? So if you're 60 years old, you would subtract your age from 100, and that's how much you would keep in equities. So you'd have 60% in bonds, 40% in equities. But now that's being called into question, and they're saying, should we really be using bonds in a rising interest rate environment? We had a Yale professor that wrote an article here recently that I think actually won a Nobel Prize for his design of saying back testing and finding that if we go into a rising interest rate environment, we're going to be much better off off if we take a portion, if not all of that 60% that was supposed to go in bonds and placing that in fixed indexed annuities. Dr. Weade that was on our Retire with Purpose podcast not long ago, he also advocates using fixed annuities or immediate annuities as a solution rather than using bonds in a rising interest rate environment, of which it looks like we're going to see in the future. And that's what this article said. Use the rule of 100. And that's probably one of the things I didn't really like about this article is there were some blanket statements that were made. I think we've got to be very careful with that rule of 100. I mean, for this individual, when we put 40% into a fixed indexed annuity, that was because that was exactly what would take care of his retirement income needs for 5 years if we had to stop taking withdrawal from the investment program and start taking distributions from a protected place that hadn't taken losses while he let his market money recover. And so it's very, very different for every single person. You can't make a blanket statement like that and say you need 40% in fixed index annuities because you are 40 years old. Yeah, and another thing I didn't like about the article, I'll provide you with articles I don't necessarily like everything in and explain to you why, because I do want you to see both sides of the coin. And one of the things is about halfway through the article, they finally told you what product they were talking about. You're reading this article and it's telling you how a fixed index annuity works, but they don't tell you it's a fixed index annuity until halfway through the article. And one of the biggest problems with annuities that people have in their head is that they have these misconceptions that are created out of confusion because it's not clarified what type of annuity they're actually referring to. Are we talking about an immediate annuity or a guaranteed income annuity, a fixed indexed annuity, a variable annuity? They're all very different. They should have told us what they were talking about on the very front end of this article. Another thing I didn't like is they said anybody can find an annuity that's right for them. That's not true. If you've got a 25-year-old individual, for instance, that's 40 years from retirement and they need as much growth as they can possibly get, they shouldn't be putting their money in annuities. They should probably be utilizing a higher yielding potential place like the stock market, largely equities, maybe including international equities, alternative investments. They should have this diversified, more aggressive portfolio that can deliver to them more like 7 to 10%, not 3 to 7% or 3 to 6% like they might see in a fixed index annuity. And so again, there's some things I really liked, some things I didn't really like.
So one of the knocks on annuities is that it really hampers your liquidity. Your cash is tied up. What about that?
Well, and the article goes into what you can expect in the way of liquidity. I think one of the common misconceptions, as it was listed out here in the Forbes article, is saying that your money's not gone, right? And really, there's only one type of annuity where your money's gone, and that would be an immediate annuity. You've actually annuitized your dollars, much like a pension. Teachers can do this with their 403B. They can take their teacher's retirement account, they can roll it into their pension, get a guaranteed income stream for the rest of their life. If they pass away tomorrow, then all that lump sum is gone. But they've got a guaranteed income stream for the rest of their life. And so that really only pertains to immediate annuities or an annuitization, in other words. If we take a look at fixed annuities or fixed indexed annuities, these are places that will give us relative liquidity, typically 10% of our account value every year. When it comes to CDs, it's typically, whatever your interest was for that particular period. You get interest only. With a fixed indexed annuity, you get 5 to 10% typically. And if you have, sometimes they have cumulative withdrawals, so that could be year 1 it's 10%, year 2 it's 20, year 3 it's 30, up to say 50%. And so you can take more and more out each and every year as you delay. The more liquidity you get, the less growth potential you probably have.
Well, if there is an annuity in your portfolio and you'd like to learn more about it and whether or not it's really a good fit for you, the number on your screen is the first place to start, because that's going to put you in touch with a member of the Howard Bailey team who can sit down in a complimentary consultation and review what's going on in your portfolio. Is that annuity a good fit? Is there an opportunity for you to create the lasting income that we all need in retirement? Caring for ourselves in an unexpected healthcare situation. If you have to go into a nursing home, how are you going to pay for that? Does your portfolio include a provision for that? And then what about fees, taxes, and expenses? Are you paying more than you need? All of those things will be reviewed when you sit down and visit with a member of the Howard Bailey team in a complimentary consultation that's available to you when you call the number on your screen. We are back in just a minute answering your questions, so stay with us.
At Howard Bailey Financial, every dollar has a purpose. We call it the purpose-based retirement. A certified financial planner will help you decide what you need your retirement money to do for you. We put together a written plan that puts your dollars exactly where you want them to be. And we put every dollar to work to maximize your retirement efficiency. For a higher level of insight and care, choose the purpose-based retirement from Howard Bailey Financial. Call us now to set a complimentary consultation.
If you have a question for Casey, you can send it to info@howardbailey.com. We might check back with you and invite you to be part of the program. And that's what we've done with Floyd in South Bend.
I've been studying up on this family banking concept. What's your opinion on it, and who is it right for?
Well, Floyd, I think you're asking the right question. Who is it right for? Because it's not right for everyone, and there's probably more people that it's wrong for than it's right for. This is really a concept that's meant for really a select few, probably the 1%ers in the country. These are individuals that are high net worth or have very high incomes, or they have a substantial amount of after-tax funds, and they have some specific goals in mind. And largely, these are legacy goals. So if you've got a high income, you're probably maxing out your Roth IRAs or your Roth 401k, your HSA, maybe putting money in a 529 plan, and you're looking for other tax advantage places you can go. Garrett Gunderson is one of the premier experts in this area who focuses on creating a legacy, a lasting legacy for the next generation. And this is in one of his books where he talks about the Rockefellers and how they had a multi-generational legacy that they could leave behind. It was this family banking concept. It was overfunded cash value life insurance where they could take tax-free income and really, rather than using it for themselves or their own business, it would be used to loan to their family or their friends so that they could be the bank for the family. And I say again, this isn't right for everyone because not everybody's in a position where they've got that much excess cash that they can act like the bank for the family. I've got two clients that I've worked with over the past 12 months where we've established specifically a family banking concept. This wasn't for their own income purposes. In the future, it was for their family bank. One individual is taking a large chunk after selling a business and setting it aside into this new policy. So because one of his goals is he wants to be the bank for the family. He wants to provide funding for them to open up businesses, to pay off their student loans, pay off banking institutions, offer them a lower interest rate that they pay him back, and that wealth then stays inside of the family rather than going to a banking institution for that matter. Another gentleman that we also established this plan for is someone that had a large chunk of after-tax assets that were in the market, and he was sick of paying taxes on those things year after year as they were wrapped up in mutual funds, kicking out capital gains and dividends and interest, and he wanted those things to grow tax-free as a legacy to the next generation. And here a few years down the road, he knew that his children were going to want to buy a house, buy a car. He wanted to send his grandkids to college, so he'll use it as a college funding mechanism. He'll use it to help fund their first home purchases, and then they'll pay him back over time. And the interesting thing is when he takes those loans, he's going to have a net interest loan that's zero. So he won't actually be paying interest because the policy will be making as much or more interest that he's paying in the way of the loan interest. And he's collecting interest from his children to put even more cash back in the policy and leave a larger and larger legacy behind for the next generation. So again, I'd say exercise caution as you enter this realm. Make sure you explore all the different options that are out there and you get the right one that's set up the right way for the right reason.
That's a fascinating concept, isn't it? Let's get over to Ohio and Deb's question.
In your opinion, what's the biggest risk facing retirees today?
Well, Deb, in my opinion, and I would say this is also in Dr. Weade Pfau's opinion, the professor of retirement income that was recently interviewed on our Retire with Purpose podcast. He is a doctorate, and he really knows what he's talking about. He's also a chartered financial analyst. He's done a lot of research into the retirement realm, and he said, given today's market valuations, there is a big risk that people that are retiring today are retiring in a peak bull market, and they're going to experience maybe a major pullback in returns in their first few years of retirement. And maybe it's not even that they're going to see a major pullback of, say, a 40, 50, 60% loss in the market, but instead they might see lower returns given market valuations long term. So maybe we see a better control from the Fed where we don't see quite as much volatility, but we see lower long-term returns. Dirk Cotton was also featured on the podcast. He said the same thing. It's this risk of future market returns and what they might look like and which sequence that they ultimately occur. If we have a recession or a major market pullback on the back end of retirement, not nearly as damaging as if it's in those first few years of retirement. We call that the retirement red zone. That is the first 5 to 10, 15 years of your retirement. You need to focus on putting together a plan to deal with market pullbacks. If everything you have is stuffed away in the same investments you had in your 401k, typically say stock mutual funds, and we experience a pullback, where are you going to go for income while you wait for that portfolio to recover? Because the market has always historically returned back to its previous level and beyond that, but it's taken some time. In some instances, we can go all the way back to the 1920s after the Great Depression. It took 25 years. If you had $1 million right before the Great Depression, 3 years later, you would have seen at the bottom of the market that $1 million turn into $110,000, an 89% loss. If you just sat on your hands and waited for it to come back, it would have taken a total of 25 years to get back to your original $1 million investment. So how much time do you have? And you need to start buying yourself some time to go through a potential negative sequence of returns if it occurs as you step into retirement.
Our next question is from Mohammed in Warsaw, and he writes, my parents are in their mid-60s, and some advisor just put all their money in 3% fixed rate annuities. How do we get the money out and someplace better?
Well, Mohammed, I think we're asking the question in the wrong sequence. I think the question should be first asked, what is the plan? Why did they get these fixed rate annuities in the first place? And I would start by just doing some simulations. Let's run a comprehensive retirement plan and see what their required rate of return is. How much do they need in the way of return in order to actually have a successful retirement? What if you find out that what they need in the way of return is 2%? Well, if they only need 2% in the way of annualized returns in order to have a successful retirement, then 3% really isn't all that bad. And if the stock market loses 50% over the next 12 months, your parents are going to be really darn happy they had that 3% fixed rate annuity. And then you could start looking at solutions as to, well, how do we get these dollars back into the market now that we can buy in at a better valuation? And typically these types of products will have a withdrawal that you can take every year without a penalty, say 5, 10% of the account value every single year. And so you can start systematically dollar cost averaging back into the market until that surrender charge period is up. Maybe it's 5 years, 7 years, 10 years, at which time you might have the bulk of the dollars back out in someplace better. Maybe as interest rates are rising, you're finding that you can now pick up a 4% fixed rate annuity, a 5% fixed rate annuity for maybe even a shorter term. Maybe you're going to take that free withdrawal every year of 10% and move it into a higher yielding or higher potential area, a higher fixed rate annuity with or a fixed rate annuity with a higher potential, or maybe a fixed indexed annuity with even more potential, or you're moving it back into the market. And so again, let's focus on the plan, see what the required rate of return is, and then go from there to see how much risk they actually need. Maybe they don't need the risk. Maybe they just want to have peace of mind to know they're going to be okay.
What is your required rate of return? Do you know? One way you can find out about questions such as that is to meet with a member of the Howard Bailey team. And the number on your screen is the first step toward getting there. Call that number and schedule a visit with a member of the Howard Bailey team, and we'll take a look through your portfolio to understand a little better how you are provisioned for the future. What about taxes and expenses that you might not need to pay? Is there a provision for a long-term income, one that you can outlive? Can that be created for you? And then long-term care. My gosh, that is so important and often often overlooked as people plan for their retirement. Those are all things that you'll recover and review when you sit down with a member of the Howard Bailey team after you call the number on your screen and schedule that visit. It's time well spent. I hope you'll take the time to do it. Here is our question of the day, and it has to do with Social Security. What is the cost of living adjustment for 2019? We have the answer when we come back.
At Howard Bailey Financial, every dollar has a purpose. We call it the purpose-based retirement. A certified financial planner will help you decide what you need your retirement money to do for you. We put together a written plan that puts your dollars exactly where you want them to be. And we put every dollar to work to maximize your retirement efficiency. For a higher level of insight and care, choose the purpose-based retirement from Howard Bailey Financial. Call us now to set a complimentary consultation.
I'm sure this one's going to be interesting you if you are receiving Social Security. How much of a pay raise is coming your way this year? That was our question of the day. How much will the Social Security cost of living adjustment be in 2019? Casey?
It will be 2.8%. C. And there was an article in Fox Business here recently that we actually made part of our weekend reading that listed out the 2.8% increase, but also talked about the potential problem that 2.8% just isn't enough. Yeah. And a lot of the families we're working with, they're going, that's just not enough. 2.8%, what's that? That's not covering my increase that I've seen in my prescription drug costs, or there's going to be some fairly large Medicare premium increases for a lot of America in this year, in addition to how quickly utilities and the cost of housing has increased. We're not seeing these cost of living adjustments with Social Security keep up with these areas of inflation that retirees are largely spending their dollars on. And that could be because we're using the wrong inflation adjustment measure, right? We're using what's called CPIW, and that's incorporating a lot of things that retirees just aren't spending their money on. We've talked about using branch chain CPI or CPIE and focusing more on where people are actually spending their money in that over 60 age group. And these are things like prescription drugs and healthcare costs. And if we included those things as a higher weighting, then we are going to see that inflation adjustment happen at a higher rate and maybe actually keep up with these things. But we're not seeing that happen yet. We're not seeing any changes that are ultimately going to result in you having a dramatic change in the amount of cost of living adjustment you're getting in Social Security. And so you have to make sure you're positioning your portfolio to help you not just keep up with inflation, but beat inflation over time. And so what we're going to talk about today is we're going to talk about how we can position our portfolio with the most appropriate vehicles, the best in vehicles that can act as the very best inflation hedge inside of your portfolio. And this isn't where you start as you start planning. You start by first starting with liquidity, then going to income, growth, and estate planning. If we look at liquidity, we set up an emergency fund. We put together an income strategy that can give us a consistent, reliable income. Then we put together an inflation strategy because inflation doesn't happen overnight. We can take on some more risk with that part of our portfolio. We don't feel it immediately, and so we can have a long-term growth portfolio utilizing risk-based assets that have done the best to keep up with inflation over time. And finally, we can get into estate planning. We can get into long-term care planning and legacy planning. Right now, we're going to be talking about growth planning to play defense against inflation. And we ask ourselves, what about gold? I know we get that question all the time in our office. Is gold the very best inflation hedge? And historically, no, it has not been the very best inflation hedge. In reality, it hasn't even kept up with inflation if we look at certain time periods. If we look at 1975 through 2017, we see CPI, the Consumer Price Index, increased 581%, while gold prices increased 375%. So we actually see gold underperforming inflation over extended periods of time. So what might make a better inflation hedge? Well, we can see those bottom lines that we almost can't even see. They're all the way down there at the bottom. That would be CPI, inflation, and gold prices increasing. The next best inflation hedge would be investment grade bonds, and then the S&P 500 index, also known as U.S. equities, and then we get into real estate as the best inflation hedge out of all of these different options. How much of an inflation hedge in comparison to gold is it? How much better does it really perform during high inflationary periods? Well, we can see during high inflationary periods from 1978 through 2017, equity real estate investment trusts, or real estate, outperformed and performed very successfully 69% of the time during those inflationary periods. If we look at a combination of not just gold, but commodities in general, 68% of success ratio during high inflationary periods, 65% for U.S. equities, and 58% for Treasury inflation protection securities, also known as TIPS. Only 43% of the time has gold been a successful inflation hedge during high inflationary periods. So why has real estate been just so successful? Well, I think this can be explained in just this one simple chart. We buy a piece of real estate, we might have a mortgage. We lock in that mortgage interest at a set rate for a set period of time, the next 10, 20, 30 years. Over that period of time, we've got a rental property, because when we talk about real estate, we're not really talking about your primary residence. We're talking about an investment property or real estate property that can generate income via rents. And so over time, we see those rents increase while we see our mortgage interest expense stay the same. Well, what about equities? What have we seen over time? As we dive deeper in the numbers, we can see over long periods of time, equities have performed very well in both high inflationary periods and low inflationary periods. Even deflationary environments, we've seen equities have very positive returns over long periods of time. So let's put these side by side, and this can be very insightful as we're evaluating each one of these different inflation hedges. First, we can take a look at the annualized return. From 1975 through 2017, gold has returned an annual 4.6% per year, while inflation has averaged 3.7% over that same period of time, meaning that we've netted a 0.9% or a real return of a little under 1% a year if we just bought and held gold. If we look at investment grade bonds, we would have netted 4.5%. S&P 500 netted 8.4%. If we look at real estate, best inflationary hedge, we would have netted 8.7%. I think the biggest part of this chart that we should look into is that standard deviation, also known as annual volatility. How far are these things swinging? What is the risk correlated with each one of these asset classes? We can look at gold. We see 19.5% in annual volatility. It's the most volatile asset class with the largest swings in its pricing, and it has the lowest annualized return. If we look at investment grade bonds, we see an annualized return of 8.2%, significantly better inflation hedge, and annualized volatility that's a fraction of what we see in gold. We look at real estate, the highest volatility, second highest to gold, but it's also seeing the best inflation hedge over time. So would we rather hold on to real estate or would we rather hold on to gold? That's a question you have to ask yourself as you ask yourself if you are positioned well in order to beat inflation over the long term. Can you increase your income throughout retirement with the portfolio strategy you have today to actually see higher cost of living adjustments due to that portfolio than you're actually seeing in your Social Security? And if you're not sure, it's time to sit down with our team and analyze all those things that you've got inside your portfolio and make sure you've got the very best inflation hedges for your retirement.
And let me help you get that started. It's really easy to do. The number on your screen, the toll-free number that's on your screen right now, is a number to call to find out exactly when is the best time for you to meet with a member of the Howard Bailey team. They'll schedule a visit and sit down and walk through what inflation protection is in your portfolio today, if any. How much market risk are you exposed to? Taxes, fees, expenses. What are you paying that you could escape? Lots of factors that all come into play to create a successful retirement. And that's why it's so important to have a comprehensive plan. And the first step is a complimentary consultation with a member of the Howard Bailey team at the number on your screen. That is all the time we have for this week. We'll see you next week.